Most traders think that market structure is about identifying highs and lows, and that's exactly why they keep getting trapped on false breakouts and reversals. After years of studying the markets and now being a six-figure trader, I've realized that retail traders and professional traders read market structure in completely different ways. Retail looks at where price has been. Institutions and professionals look at where price needs to go. In the next 15 to 20 minutes, I'm gonna give you my complete market structure framework, not the textbook versions that don't work, but the real way professionals use market structure and position themselves in the market. By the end of this video, you'll understand how to read market structure like a professional and why this knowledge is the foundation of everything else in trading. Now, normally within a market, you're gonna see accumulation areas like this. And a lot of the time, what retail traders will do is they'll wait for the market to break higher and pull back to then possibly take a long to target higher. And this is what we call a break in retest for retail traders. Now, the problem of this is the complete opposite of what actually is most of the time going to happen. What most of the time is going to happen is we are going to come up to these highs, sweep them, to then break back lower and completely reverse. Now, why is this happening? And there's a couple things that we need to understand when it comes to market structure and what we're looking at right now. Number one is the first thing we need to know is trends. Obviously, there's bullish and bearish trends. When a market is in a bullish trend, we are making higher highs and higher lows, right? This is what a bullish trend looks like. Now, in a bearish trend, we're making lower lows and we're making lower highs. Now, inside of these trends, there is something that we call accumulation, manipulation, and distribution. It's the same thing that the market is constantly doing. The market is constantly doing one of these three things. We're either accumulating, we're either manipulating, or we're either distributing. So what we call of this is a power of three. This is where we expect accumulation, this is where we expect manipulation, and this is where we expect distribution. Now, the problem with a lot of these traders, and maybe something that you've been experiencing, is every time that you maybe take a break of structure or you enter a trade, it immediately reverses on you and it goes the complete opposite direction. Now, what is happening here is you need to understand why the market is moving, right? Where does the market want to go? The market is all based off of liquidity. It's a constant distribution of liquidity. Now, liquidity within the market is highs and lows. So in this initial accumulation area, we are generating what we call buy-side liquidity to then go take that buy-side liquidity to have a fake break of structure where all of now the traders are entering into their long positions, which is generating liquidity because there needs a lot of orders to fill positions, which then ends up stopping those traders out when it reverses so that smart money can enter in and flip the market to go towards the opposing liquidity, which are the lows or the highs that are in the opposite direction of that. So I'll show you what the bullish example of this looks like. Now, the bullish example is very similar where we're generating highs and lows to go take those lows to then reverse and have a move higher. Again, this is where we're expecting accumulation to then see manipulation to then see distribution, right? So this is what we call power of three, or just accumulation, manipulation, distribution. Now, this is what the market is constantly doing, right? And the main thing that I want you to understand as to how we can rearrange our thought process within the market is if we know that the market is constantly drawing towards highs and lows, how do we understand where manipulation is going to take place? It all comes down to displacement. So what is displacement and what's the difference between displacement and a sweep? So when we have some sort of high or low within the market, and let's say these are our highs and these are our lows. When we end up coming to these highs, there's two things that we can do. We either displace through it and then pull back and then continue higher, but notice we're displacing, or what we do is we come up, sweep it, and then go back lower. Notice the sweep all comes down to how much and how aggressive the market is actually pushing through that level. So it's either displacement and a break of structure, or it's a sweep of liquidity to then go towards the opposing liquidity, which is whatever the highs and lows are within the market at that time. Now, how do we take advantage of this? What's the most important thing to learn from this? Well, if we know that if the market sweeps liquidity, it's most likely going to be manipulation to flip the other direction, that's how we can take high probability setups. Now, I want you to look at this range, right? When I look at this range, what are we currently doing? We are currently accumulating, right? So we're building a lot of accumulation here. So what would I expect to see? Well, the first question I have to ask myself is, where can I maybe expect to see manipulation? At the highs or at the lows? And what would make more sense? Well, if I'm expecting to see manipulation lower, then that must mean there must be a reason for the market to go higher. And what's the reason for the market to go higher here? All of this buy side liquidity that is resting. There's equal highs here. There's a high here. all of this generated buy-side liquidity that we've been creating, right? All of this is acting as a reason for the market to move. So what happens is retail traders end up waiting for a break to try to enter short to go lower. And what ends up happening here? We end up sweeping it and reversing. So this is where we expect to see our manipulation. And what do? To take a trade, we wait for a break of structure. So what my break of structure is the down close candle. When I look at the 15-minute, these down close candles, the last two, I mark my break of structure like this, where it's the last down close candle, two series of down close candle. And as soon as we get above this, we want to take a long in the opposing direction to target the opposing liquidity pool, right? Because we're expecting now accumulation, manipulation, and then distribution to the upside. So when all of the retail traders are taking those trades, they're getting stopped out, which is generating liquidity and more orders within the market for smart money to now enter their positions. Let's see what happens here. Market ends up continuing its distribution phase before rebalancing lower and continuing higher towards all-time highs. So what do we want to take away from this? The market is constantly doing one of two things, or one of three things: accumulation, manipulation, and distribution. And in those cycles, we are generating liquidity and accumulation, right? We're generating these highs within the market. We're also generating lows within the market. And then accumulation, which is we're going to then hunt that liquidity, take that liquidity, which is we're taking the low that was formed here on the initial low that got put in before putting in a high, and then generating, and then move lower, where we expect to see accumulation. And then we expect to see distribution towards the highs that have already been generated previously in the session. So what we want to look for is the times in which the market actually does break structure. And how do we know to take a long or a short? It all comes down to two things: displacement, manipulation, and the draw. Three things, actually. Is there a reason for the market to go higher? Meaning, is there highs resting above us? Is there buy-side liquidity? Number two, do we displace through the high, right? Notice the market moves through it and we don't just take it and again fall back down. Do we displace through it? And number three, is it a form of manipulation? And meaning, did we take sell-side liquidity? So did sell-side liquidity get taken already and then we have a break of structure? And notice when we look back to this example, we do all three of those things. We generate liquidity. There's a reason for the market to go higher before taking liquidity. So we know that this is not a break where we want to take a short, but instead wait for the reversal. Wait for a break of structure to the upside before the market continues higher. And this is where we look to take a long towards the opposing liquidity. Now let's look at another example. When we look at this chart, we can identify our areas of buy side. I can say that this is my buy side liquidity. I can also recognize that there's equal highs resting here. This is high probability buy side liquidity. And then there's also sell side liquidity down here. So I want the market to take one of these first, right? Because I don't know necessarily what we want to do yet. So I'm going to wait for the market to take one of these areas of liquidity. Boom. The first thing we do is take out buy side liquidity. Let's go back and watch this. Now, notice, do we displace through it or do we sweep it? We immediately sweep it. The highs get taken, we take the high, and then immediately sell back off. So where do I expect to go? The opposing liquidity, right? All of these stacked lows that we have down here. So where would I be looking to take an entry? Well, I would wait for, again, my series of down close candles to be broken. So when I zoom in on the lower time frame, I look, and right here is where I would be taking my entry, which is the series of up close candles on a down position and a series of down close candles on an up position. So if I'm looking to take a short, notice 1, 2, 3, these are the last series of up close candles. As soon as we close above it or below it, sorry, I want to take my short and I want to target the opposing liquidity pool. Now notice there's a couple things that happen here. Number one, this is our first area of a price target. So once we take this internal low, which is my first price target, I take partials. Then what we can expect to do is rebalance to then continue back lower. And again, the same exact thing is happening. We rebalance back lower to then break below the series of down close candles to then continue towards the opposing drawn liquidity. Now let's wipe the slate clean, because now a form of sell side liquidity just got taken. So what could we possibly do now? Well, there's still buy side liquidity resting above us. Do we want to displace through the low or do we want to sweep the low? Let's watch. We sweep the low. So if we look at this low, we do not displace through it, but we end up trying to go one last time, right? We try to break through it and then we pull all the way back, and then we try to break through it again, but immediately gets recovered. What am I waiting for? A series of down close candles to get broken above. So notice this big long series of down close candles, and we start to break above it. This is now telling me that I'm expecting this to be my manipulation to then reverse towards the buy side liquidity that we had originally generated. This is where I want to take a long position, not to try to catch a continuation lower, but to reverse it, because now that sell side liquidity has been taken. And when you look at the bigger time frame, we've swept this low. Notice it's all wicks. The wicks will show the damage and the bodies will show the narrative. When the bodies are continuing to close above this low, right? Notice the body closes above, the body closes above. It's showing signs that we are sweeping liquidity and that we want to reverse. What do I wait for? A series of up close or down close candles in this case, because it's a reversal to the upside. So the down close candles, we close above, I enter a position, I set my stop loss, and I'm targeting the buy side liquidity that we had originally generated. And what do you see ends up playing out? We end up taking the low before flipping back higher to go take the buy side liquidity that we had originally generated. Now the market starts to slow down. This is where the overnight session ends up opening up. But if we skip ahead here and we continue to watch this play out, you will see we end up working higher towards that buy side level. And again, where do we think we're going through it? Towards probably the next buy side level as well. And we'll go to a bigger time here so it starts to smooth out. And there we go. First high gets taken. And then the next high gets taken. So what do we want to understand? The market is constantly going from buy side liquidity to sell side liquidity. Normally we have cycles of accumulation. We have cycles of manipulation. Then we have cycles of distribution. So we can see that this is our manipulation and this is our distribution. And all of this is our accumulation, right? All of this where we're kind of sitting in this range, we're not really moving much. This is where we're seeing our accumulation before having manipulation and then expecting to see distribution to the upside. So let's look at another example, right? When I look at this chart, what do I want to identify? Where's my sell side liquidity and where is my buy side liquidity? Where is my buy side liquidity? Obviously the high of the range. And where's my sell side liquidity? There's a couple lows that I watch here. I would mark this and I would mark this. Now, what do I need to wait for? I need to wait for liquidity to be taken, right? So what ends up happening? We're watching. Now liquidity gets taken. Again, we're watching. Do we displace through it? If we displace through it, then we can maybe try to catch a continuation. If we sweep it, we want to play the reversal, because this is where all of those shorts are getting trapped for the market to reverse, to smart money to enter their positions and reverse the market back higher. What do we end up doing? We end up reversing. What ends up happening? We close above the last down close candle, having displacement higher. This is where I would expect to take my long position, stop at the low. And again, I'm targeting back towards the generated buy side liquidity that we had initially put in. So what do we wait for? We let the market do its thing, and we end up working towards buy side liquidity after sell side gets taken. Notice we do not sweep, or we do not displace lower. We sweep these lows before working towards buy side liquidity. And what ends up happening internally here? We end up generating a low to sweep that low to then, again, continue price higher. And then we end up taking that high. All right, let's look at this example. What am I going to do? Mark out my buy side liquidity, mark out my sell side liquidity. What do I want to see the market do? Take one of those areas of liquidity. Waiting for the market to take an area of liquidity. Do we displace through it? I'm watching. Oh, displacement back down. What do we get? A change in the state of delivery, right? This is where we break structure to the downside. This is where our series of down close candles, when we wait for displacement back inside the range. And this is where I look to take a short position. Look to take a short, stop at the high. And again, I'm targeting the opposing liquidity pool. And all comes down to, do we displace or do we sweep? And is there a reason for the market to go lower? Why is there a reason for the market to go lower? Because we have generated sell side liquidity here. We have generated sell side liquidity here. And we have generated sell side liquidity down here. So let's see how the market ends up playing out. Now, what you can also expect to see is if the market is now bearish, what we can do is generate internal buy side liquidity, sweep that buy side liquidity, and then go lower. So if we see it happen here, I'll watch an example. Watch. The market comes up, takes out the highs here. Notice that we do not displace through them. And then we end up continuing lower. We continue to watch, and there we go. We end up going towards the opposing liquidity pool and ends up getting our price target hit. But what I want you to notice is when the market is bearish and we have a strong draw, it'll do the exact same things even internally because market is fractal. The same things that happen on a bigger time frame will happen on a lower time frame. The market comes up, takes the highs. We do not displace through it. Again, closing below the down close candle before selling back lower, rebalancing to that down close candle, taking, again, another high here that we generated before closing below the down close candle here, and then having that last push towards sell side liquidity. I'm hoping that this is starting to click for you, right? The market is constantly either manipulating, distributing, accumulation, and in those cycles, we are generating liquidity constantly, and we were always switching from sell side to buy side liquidity. And the way to recognize it is asking ourselves, do we sweep liquidity or do we displace through it? So number one, do we displace through liquidity or do we sweep it? Number two, once we sweep it and we break structure, is there a reason for the market to go lower or higher based off of that sweep? In this case, is there a reason for the market to go lower? Yes, because there's sell side liquidity resting below us. Once we can have this combination and we can also align manipulation and distribution and accumulation, we will understand why we start getting stopped out and why and where to actually put ourselves in a position to take advantage of institutional market flows. Market structure isn't about drawing trend lines and hoping that it holds. It's about understanding how institutions think and how they hold their positions and how they capitalize on their position. When you start reading market structure like an institution as a liquidity roadmap rather than a pattern recognition game, everything else in trading becomes so much more clear. You're gonna stop getting trapped by false breakouts and start positioning with smart money. Go to your charts right now and start looking at liquidity, displacement, and breaks of structure. Ask yourself, is the market going to hunt liquidity? Did we sweep it? Did we displace? Who benefits from this move? This simple shift in perspective will transform your trading, I promise you. Remember, the goal isn't to predict where the market will break. It's about waiting for the market to show us first and then reacting to it. If you're interested in getting more help with your trading and understanding market structure as well, I will leave a link in the description to our mentorship private group. This is where I live trade every single day, showing you these concepts in real time. You get access to an entire course curriculum going over my entire strategy, everything that I know about trading. You get access to coaching calls so that I'm able to help you keep accountable, making sure that you're taking the right setups and positioning you for success. If you guys enjoyed this video, like, comment, and I will see you in the next video. Peace out.